Tech stocks are down. Netflix is down 70%. Shopify is down 80%. And most tech stocks are way, way down. Most startups are obviously not listed on the stock exchange, but I guarantee you that this has a major impact on fundraising right now.
Private markets use public markets multiples. And when you see that tech stock goes down, valuations on private markets go down, especially in growth segments. So the growth at all costs mentality is no longer rewarded. Let's make sure we get like baby formula before we transition to metaverse.
Today we're going to look at how to fundraise while the stock markets are crashing. What's happening and what can we do about it? This is Raw Startup. I'm the founder of Vivino, the world's largest wine app and wine community with almost 60 million users all over the world. I've seen the journey going from a tiny angel round to raising a mammoth $155 million D round for Vivino. I've raised over $200 million for Vivino alone. I've seen a lot of good times when it comes to fundraising, and I've seen some bad times. And right now looks like a very, very difficult time to raise money. So for this video, we also have an expert. Olga is a VC, and she'll help us find the right answers. Finally, in the video, I'll make a list of takeaways on what you should and should not do in the current funding environment. With that, let's get going. Valuations are going down. So the public markets do really impact what the valuations are on private markets right now.
Private markets use public markets multiples. And when you see that tech stock goes down, valuations on private markets go down, especially in growth segments. And we will see a rise of down rounds and bankruptcies in these businesses that were stuffed like turkey earlier, but they have no culture of financial discipline and sustainability of growth.
Okay, let me try and explain that with a simple graph. Let's have a look at this graph. On the x-axis, we have time. On the y-axis, we have value or valuations. We start up on the right with a future IPO price. So the investor is thinking, okay, if I was going to sell this company a few years from now, this would be the price. Then they calculate backwards and say, okay, this means I can pay this much right now in investment. Now, in the current market, all the prices have come down. So now we have a new dot on the line in the future saying, this is what I think I can expect because the markets have gone down. Then they do the math again and go backwards. And as you can see now, they can only offer a lot less for the startup. That's how they impact each other. And the future thing on the right, that could be an IPO, that can be a trade sale or whatever. As soon as those numbers change, it impacts any investment earlier on. So are specific startups going to have a hard time and others might benefit in this situation?
I think buzzy categories that just emerged out of nowhere over the course of last couple of years are going to be in deep troubles because their long-term potential is not clear. And I'm talking about 3.0, I'm talking metaverse, I'm talking certain crypto startups. I think what will benefit, who will benefit from this crisis is companies disrupting industries that are massively important for GDP growth. Think the supply chain, think agriculture, think logistics, think infrastructure, resistance, like recession-resistant, recession-proof markets, like emerging markets, will also benefit from that.
Investors become more selective. So one thing to understand here is that venture capitalists also raise money. They raise money from their investors, also called LPs. VCs would usually raise money every 3 to 5 years from their investors. But in the past few years, things have been a little crazy.
It used to be that you raised every 3 years, 4 years. Right now, last few years, investors raised money every 18 months to 24 months. So now I think what is happening is the gravity comes back and we go back to a more traditional pace of capital deployment and fundraising that it just becomes more normal, I think. People invested all of the funds within 18 to 24 months. Right now, I think we will get back to thinking about investing within 3 to 5 years.
So basically, this means that investors have a longer time to deploy the same amount of money. They'll have to do fewer investments and be more selective. A move from growth to profitability. And things are totally changing here. Let's have a look at what investors look for right now.
So the growth at all costs mentality is no longer rewarded. Investors focus on companies with a clear path to profitability, or ideally profitability in place. And not just in the moment of time, they focus on the companies that have positive trend. That means sustainable midterm to long-term growth. So What you want to focus on critical metrics like LTV to CAC ratio has to be normal, organic rate growth has to be substantial, marketing expenses have to go down. Right now, you actually need to show that you know whom to sell, that the customer is ready to buy, and you have sustainable channels to execute the sales through. That means that you need to deprioritize short-term, high, boosted growth in terms of customer base or revenue delivered in a non-sustainable way for the sake of understanding how your core business will grow, maybe at a lower rate. Maybe you will not be growing like 30 to 40% month over month. Maybe you will be growing at 10 to 15% month over month.
It will be fine to grow slower and in a more sustainable way. Funding rounds will take longer. Yes, funding rounds will take longer. It will just take longer to close any round because the pressure from the fast money isn't there anymore.
Going back to the last couple of years, we saw rounds closing within 24 hours with absolutely no due diligence. So this cheap capital is no longer available. That means that traditional venture capital investors, they no longer need to rush to that point. They no longer need to be faster than Tiger, to be more accepting than Tiger. So now they can get back to business when they have a month, 2 months to run the due diligence on the company. They can afford it because of the scarcity of alternative offers, like fast-paced, fast-speed offers.
A change in mindset. Then there's a change in mindset. Things are changing fast and we have to adapt quickly. This is not new. This happened during COVID too. Some people adapted fast and really made it, like Airbnb. Others could not adapt and died. Some people need to come down to earth really fast after having flown really, really high for a very, very long time. If they don't adapt fast, they'll have a very, very hard landing. Adapting like that is not easy.
Even like when you look at how the founders behaved early in COVID crisis, a lot of them were in the state of denial. A lot of them were not fast with responding to changing market environments because they thought it would go away. So they thought it would be like a couple months. They don't need to cut the costs. They don't need to fire people. They don't need to get rid of excessive, projects that are not contributing to core businesses because they thought nothing can actually hurt them. So I think accepting the reality and dealing with the reality and focusing on the constraints versus opportunity, it's a huge transition, especially for those founders who raised these expensive rounds and were on the cover of TechCrunch just months ago. It will be hard from, going from being a tech darling to a person who has to lay off like hundreds of employees in order to survive. It's the most adaptable who will survive, not the strongest one.
We've touched on this already, but finally, what can we do about it?
Well, first of all, if you have less than 6 months of runway, you have to go and try raising at whatever condition the market has to offer, because we don't know how long the recession would last. Capital is in essence to survive through the recession that has no clear ending in sight. That's one of the most important things. It's not about getting something that you like as an offer. It's more about going and raising cash to survive. Second thing is cut the excessive cost like yesterday. It's even if you are not yet impacted by the crisis, even if your business model is recession proof, cut the cost, cut all the projects that are not contributing to the core business. Great example will be Airbnb. The way they did it during COVID, they cut all the costs they could and focused on long-term stays only. It's better to overdo it than underdo it in the current market condition. Cash today is the king again. When you look at the investors' behavior, I think the pattern will be similar as in COVID. Like first few months, people are skeptical and they're cautious. They don't know what's going to happen. They try to be careful. But once they get used to this new environment, we get used to anything. I mean, we get used to war happening in front of our eyes. So once they get used to, they start deploying again because they raised a lot of capital, and the maximum investment period is about 5 years. So what they will be looking for is the sustainability of the business models and durability of the business. And they would look about the creative way of survival. Like they will listen to the stories of founders who navigated the crisis well, because again, we see in tech as a cyclical business. And even if you raise at the down round right now, but you navigate yourself out, you preserve your cash position, you pursue opportunities, you increase your sales, improve your unit economics, chances are you will raise again with fewer competitors. It's a substantial valuation step up and partially mitigate the prior dilution.
So here's a quick wrap up of what I think is important. With all this going on, you have to be adaptable. You have to be willing to change and change fast. When you get an offer for investment in this climate, take it fast, close the deal, take the money, even if the valuation isn't what you'd hope for. Just take the money fast. Focus more on midterm to long term and less on short term. The investors are looking for long term, sustainable businesses. Sacrifice growth for profitability. It is okay to grow a little bit slower right now. Again, we're looking for long term sustainability. If you have a high burn, cut cost. Investors do not like companies with a high burn right now. Do remember though that great startups with great founders will always get funding, even in this climate. But it will be rough for some startups. These are difficult times. You have to adapt and deal with it and move on. If you want more content just like this, please consider pressing like and subscribe so you won't miss any future videos. Thank you very much for watching Raw Startup. Now stop watching, go build something.